I just want to cover a couple of points that I've not yet spoken about. One thing I must point out is the problem with correlation. This simply means that two pairs may generally trade in either the same direction or the opposite direction most of the time. The most obvious and highly correlated of the pairs is the euro against the US dollar and the US dollar against the Swiss franc, as they basically move in opposite directions to each other under normal circumstances. So if you had bought the euro against the US dollar on one trade and sold the US dollar against the Swiss franc on another trade, risking 2% on each trade, in reality you're actually risking 4% because of the high correlation. The euro against the Japanese yen and the Great British pound against the Japanese yen can also move pretty much in the same direction the majority of the time. If you think about it, if the pairs have a common currency involved and the news comes out that affects that currency in a big way, then it doesn't really matter what involvement the other currency has, as the market will be moved by the dominant currency. This is something that you have to be aware of when it comes to total risk on your trades. Now, the best way to check out how different pairs move in relation to each other is to throw up the 1 hour chart on all of the pairs that you're interested in trading and see how they move over a few days, especially when major news is released. I also spoke about news releases that may or may not impact the markets. Now, I'm only concerned about the possible high impact type of news. Now, I've checked the Forex factory calendar and I know that I have to be on my toes at 7 p.m. tonight for the news out of Germany. And I've also set an alert for 10:30 p.m. for all the 3 major news items coming out of the US. Hopefully my trading will be finished by 10:30 p.m. so it won't be an issue. Now, sometimes there is also unplanned news that will also affect the Forex prices. Examples of this include terrorist attacks, highly sought after individuals being captured, or even some dopey Treasury official making an out of the blue comment during what should have been an unpredictable speech. Now, I've been sat at my computer, fully aware of all of the news which is coming out, when suddenly a pair just shoots up 50 or 100 pips in literally just a minute or two. It gets the heart pumping as you quickly rush through all the news trying to find out what's actually caused this blip. Now, it may be something simple, like a rumour of a planned attack somewhere in central London. It doesn't matter if it's false because the market will eventually correct itself. Just be aware that the news can come unexpectedly and move the market, which lends weight to my previous comment. Make sure you have a physical stop loss on all trades. Now, the subject of risk seems to be never ending. But as I've already stated, it is so important to fully understand risk and how it affects your trading. Now, you don't want to blow your account in just 1 or 2 stupid trades. Just going back to my example of only risking 2% on each trade. One thing that doesn't come up, that people have different opinions on, is how long you must maintain the same position size before adjusting to fit your account balance. Say, for example, you only traded the euro against the US dollar and your stop loss was always 30 pips. You decide your position size, enter the trade and end up making a profit. This will obviously increase your account balance, and if you were to maintain the same 2% risk on your next trade, then technically your position size would be slightly larger on the next trade. This will obviously increase your account balance. Now, some traders suggest that you should stay on the same position size for a session. Some suggest a week and others would suggest a month. No matter what happens, if you started that particular trading system with a 2-lot position size, you would continue to trade the same 2-lot position size until the end of the sequence, and then just readjust it ready for the next sequence according to your new balance. Others will suggest that you adjust your position size after every trade. This would get a little bit confusing, especially if you were trading other currency pairs with various stops. It will all get a little bit jumbled up and a bit too confusing. Some say this disadvantages you if you are trying to recover from losses, due to the fact that you'll be entering trades with a smaller position size if you had a few losses in a row. I'm not sure how I feel about that theory. As I've said many times, I'm trying to keep it simple. Personally, I decide on my position size at the beginning of the week and I stick with that same position size for an entire week. Come the following month, I'll then have a look at my account balance and adjust it accordingly. This works for me, and it certainly makes my life easier as the position size is automatically stored on my platform for every trade. So every time I open it back up, it's already preloaded. Now, some traders may only take a couple of trades a week, and other traders may rattle off 30 trades in a session, so everyone will have their own way of doing things. This information is just to give you ideas or perhaps provoke a thought in your mind and make you consider things that potentially you haven't considered before. And then I'm throwing my own thoughts into the mix just to give you an idea of what I do myself as a fellow trader. There is no right or wrong way at the end of the day. If you make profit and you don't get stressed out or worn out doing it, then you're definitely doing something right. For more great content like this, head over to the Tips to Pips website and join our community of over 1,200 traders. You'll gain instant access to loads of free content just like this. I'll see you there.